March 10 was bonus day for the 8,000 employees of Silicon Valley Bank. They got their bonus that Friday. Hours later, the bank failed. On Monday, customers could be seen lining up to try to retrieve their funds. Silicon Valley Bank was the bank of choice for thousands of companies in the tech sector, many of them startups, fueled by angel investors. Almost half of all the venture capital funding in the United States flowed through the bank at one time or another. And then, suddenly, it all came to an end. The speed at which things unraveled caught many by surprise, even the bank's CEO. A few weeks before the collapse, CEO Greg Becker told CNBC that the future looked good.
What we are expecting to see in 23 first half, actually even venture capital, actually a little bit more of a decline, even than what we saw in the fourth quarter. But the second half was going to kind of create that modest improvement and really set the stage for a better 24. So we're optimistic because our crystal ball is a little clearer than it was in the third quarter last year.
Perhaps his crystal ball wasn't shiny enough to predict the future. Startups struggled to raise additional venture capital due to the current economic environment. So they began withdrawing more and more of their cash from their SVB accounts. The bank had the money, in theory, but it wasn't sitting in a vault waiting to be handed back to its customers.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here.
The bank had invested the money in treasury bonds, a type of government debt in which the government borrows money and pays it back with interest. When customers started pulling their money out of the bank, SVB had no choice but to start selling the bonds at a discount so they could get enough cash to satisfy customer demand. Becker decided to publicly announce that the bank had sold off $21 billion in bonds. But those bonds weren't worth as much as they used to be because the Fed kept raising interest rates. When interest rates go up, bond prices usually go down. This is because new bonds have higher interest rates, so people prefer them over older bonds. Think of it like this. Imagine if you have a candy store and sell a candy for $1. This candy gives the buyer a little 10-cent surprise each year. If another store sells a similar candy for the same price but offers a 15-cent surprise each year, people would choose to buy candy from the other store instead. So the bank had to sell its older bonds at lower prices, which ultimately led to a loss of $1.8 billion. While Becker hoped to raise more than that in new capital, he said he had still not found anyone willing to help the bank ride out the storm. Perhaps he was looking to be transparent, but it backfired, big time. CNN quotes an anonymous bank employee as saying, "That was absolutely idiotic. Their transparency and forthrightness did them in." The extent of the bank's financial troubles panicked customers, leading to a phenomenon called a bank run, where everyone starts taking their money out of the bank all at once. The next day, customers withdrew $42 billion from their accounts, leaving SVB with a negative cash balance of $958 million. And public filings show Becker himself cashed out personal shares and options worth $2 million just before the collapse. The day the bank failed, Becker told employees, "I'm not making the decisions anymore." This is the second largest bank failure in U.S. history, behind only the collapse of Washington Mutual at the height of the subprime mortgage crisis in 2008. And then, the third largest bank failure in U.S. history happened on SVB's heels. 2 days later, on March 12, regulators shut down Signature Bank in New York to prevent the crisis from spreading through the entire financial system. A quarter of Signature Bank's deposits came from the cryptocurrency sector. But regulators denied it closed the bank because of its large hand in crypto, and rather cited what it called a significant crisis of confidence in the bank's leadership. The question now is, are there more bank failures to come? They are more common than people think. Few people are old enough to remember the 2,293 banks that collapsed in 1931, a development that led to the Great Depression. But there have been more than 500 since the collapse of Washington Mutual in 2008, although most pale in comparison to the size of SVB's. Mark Williams, a former bank examiner for the Federal Reserve, told Boston University's daily news website BU Today, "If not quelled, bank runs can spread like wildfire, crippling even the soundest of banks." To quell further panic, President Biden quickly assured Americans
can have confidence that the banking system is safe Your deposits will be there when you need them.
In the U.S., deposits in a bank are insured by the Federal Deposit Insurance Corporation, or FDIC, up to $250,000. However, over 90% of deposits at SVB exceeded that amount. The federal government then jumped in to guarantee deposits greater than $250,000. And the Federal Reserve also said it would make additional emergency funds available to eligible financial institutions to prevent similar problems in the future. Billionaire hedge fund investor Bill Ackman made a point of saying, had U.S. regulators not intervened today, we would have had a 1930s bank run continuing first thing Monday, causing enormous economic damage and hardship to millions. However, Ackman also warned more banks will likely fail despite the intervention. There's little doubt that the Fed is partly to blame for SVB's stunning collapse. Over the past year, the Federal Reserve has been aggressively hiking interest rates to tame inflation by making borrowing more expensive, which slows down spending and keeps prices from rising too quickly. And in the process, SVB got caught in the undertow. Former U.S. Treasury Secretary Larry Summers criticized regulators and also the bank's management.
I have to say that it doesn't appear on current facts that a very good job was done of regulating and supervising Silicon Valley Bank. It had committed kind of one of the most elementary errors of borrowing money in a very short-term way and then investing it in a long-term way. And then when interest rates went up, those assets lost their value.
Some are blaming wokeness for the bank's demise, implying that the collapse was related to the company's focus on diversity and inclusion. A Wall Street Journal opinion columnist wrote, "I'm not saying 12 white men would have avoided this mess, but the company may have been distracted by diversity demands." The best outcome for the failed bank is for U.S. officials to find a buyer. There will be no bailout, which typically uses taxpayer dollars to keep the company afloat. Biden does not want to reignite the anger from the 2008 Wall Street bailouts that were funded by taxpayers, especially with the presidential election approaching. The collapse of Silicon Valley Bank brings up memories of another president who took office in 1933, when banks were going under almost daily. During his inaugural address, President Franklin D. Roosevelt famously urged people not to panic.
Let me assert my firm belief that the only thing we have to fear is fear itself, nameless, unreasoning, unjustified terror, which paralyzes needed effort to convert retreat into advance.
It appears that 90 years later, Roosevelt's wise counsel has been largely ignored. Financial stocks have now lost a combined $465 billion in just one weekend. But will it be the last disaster? This crash was caused in part by the Fed raising interest rates, which they may still be committed to. JP Morgan says the S&P 500 could sink another 20% as the economy is pushed to the brink. So big institutions like them are going big into alternative assets. One alternative asset rose an average of 29% last year, handily beating stocks: fine art. Masterworks offers fully investable art from legends like Picasso, which are qualified with the SEC and broken into shares, so you don't need millions of dollars to invest. In fact, each of Masterworks' 11 exits to date has returned a profit. As a result, paintings have sold out in hours, not days. But right now, you can get priority access to skip the waitlist with the link in my description.